On any given day in the stock market, 50 to 60% of trades are completed by high-frequency trading computers. And when things get volatile, like they have been for this past week, up to 90% of trades are computers trading back and forth. The majority of retail investors, such as you and I, lose money in the market, especially when they're brand new. What's going on, everyone? If this is the first time we meet, my name is Anatoly. Welcome to Totally Invested. And if you've been here before, welcome back to Totally Invested. In today's video, I want to talk about why the majority of retail traders and investors lose money in the stock market. In my mind, there are three key differences between those high-frequency trading computers and retail investors such as you and I. The first is speed of execution, and unfortunately, computers have us beat when it comes to speed. They can analyze millions of data points within seconds and can take actions faster than you and I can blink. Number 2 and 3, though, are the cognitive errors and emotional biases that we as people carry. Now, cognitive errors are mental errors that we make when performing trades. We try to make rational decisions, but we have either limited information or wrong information. Now, the majority of cognitive errors can be fixed with education, analysis, and practice. The better you get at it, the less frequently you will be making those mistakes. However, emotional biases are a little bit more challenging to overcome. They are deep-rooted in our personalities, in our individual personalities, and they are based off how we feel when it comes to trading or making an investment, whether in the stock market or in real estate or anywhere else. Simply understanding some of these emotional biases and being able to identify them will help you in understanding your trades and how you can become a better stock trader. Before we dive in, do me a favor and hit that like button and subscribe to the channel. It'll help the channel grow and motivate me to make more content for you. Also, if you make it till the end of this video, I promise you that you will learn something about your trading behavior and learn to make better investment decisions. These do not go in any certain order, and you may see a little bit of overlap in the different cognitive errors and biases that I'm going to discuss. Check out this photo here. There's nothing overly exciting about it, right? Looks like a small city on a pier, maybe a carnival, something like that. Well, what if I show you the other side of this photo now? How does it look now? Well, framing bias is where we make decisions based off how we frame the question. So when it comes to investing in stocks, let's say you purchased a stock for $20 and I told you that during market hours today, it is worth $40. You may think, wow, that's a great return. I just made 100%, I doubled my money. Should you sell it? Well, what if I told you that yesterday it actually closed at $50 a share? What would you do then? That would alter your decision, right? You may think, well, if it was 50 yesterday and 40 today, then it just lost 20%. I'd much rather wait for it to go back to 50 before selling it. So again, depends on how you frame the question. Making portfolio decisions based off a framing bias may lead to a certain short-sightedness. You may decide to sell the stock today, but you may decide to keep it because you think, well, it's going to go back to its $50 price point. Rather, what you should do is analyze it based off your longer-term goals and look at your portfolio as a whole. How does that one stock relate to the rest of the portfolio? How does it correlate to the other stocks you hold? And what do you think it's going to do? What kind of performance do you expect from it in the future? Another cognitive error that's very common is what's called a conservatism bias. This is where you make an investment purchase based off very good, rational information. You do your due diligence and analysis, and the investment performs very well. However, you fail to change your opinion based off new information. Maybe that information is good, maybe that information is not so good, but you have to adjust your opinion based off the new information. For example, maybe several quarters the stock performed very well, quarter-over-quarter growth was high, and even higher than analysts' expectations. But in this very last quarter, earnings came in lower. If you ignore this information, then you have what's called conservatism bias. This leads to holding investments far longer than you should and limits your potential elsewhere because your money is stuck in that one investment rather than moving it to something that can perform potentially better. The way to remedy this is to research your portfolio and all the different investments that you hold and make sure that they still make sense for your portfolio considering all new information and all macroeconomic news that has come about in recent months. Have you ever researched one of your investments and only looked for good news that matched your decision? That's what's called confirmation bias. It's when you focus on only the good news and ignore any bad news that's coming in. An example of this, let's say you purchase real estate. You purchase a rental property and you purchase it based off the fact that a lot of people are moving into the area. That seems like a good decision. However, you ignore the fact that just weeks ago, an elementary school may have closed down, obviously limiting the number of renters that would be interested in the property. Anyone that has kids may look at that and go, you know what, I'll pick a different area. An example of this with stocks is, let's say you search Tesla beats earning estimates, and you find an article that says, yes, they beat earnings estimates, they've delivered more cars in the previous quarter and more cars than they expected to deliver. But maybe they also say profits are down. You ignore that information and keep the stock anyway. That is what's called confirmation bias. The way to remedy this is to actually look for contradictory information. In other words, look for the negative articles about your stock and see if it still makes sense to hold it. This next one is a mouthful. It's called representativeness bias. This is where you assume that information from the past, historical information, will persist in the present. You may neglect the idea that maybe the information you had initially was wrong, or maybe it was based off a very small data set. This would be like staying with your boyfriend or girlfriend because a year ago they were totally awesome. When it comes to stocks, it would be like keeping a stock simply because it performed really well in the past. Or maybe you classified a stock as a dividend-paying stock because it did pay dividends several quarters in a row. But in this recent quarter, maybe it didn't pay a dividend and maybe it didn't do so well. You think to yourself, well, it looks pretty similar to the way it was before, so I'm going to go ahead and keep it. That's representativeness bias. Representativeness bias. The way to fix representativeness bias is to collect as much data and information as you can about your holdings and ignore the idea that just because things look the same, that they are the same. The next one is relatively basic and intuitive. It's called illusion of control. And this is simply where you think you can control what happens to your stock investments simply because you had some positive outcomes in the past, when in fact you can't possibly control what happens to your stock. Not even the best investors in the world. Warren Buffett cannot control what happens to every position he holds. Having an illusion of control may lead to more frequent trading, which can lead to losses, as well as a bunch of fees being paid to your broker. What you need to understand is investing is based off probabilities and not certainties. You can't possibly control the outcome. All you can do is collect as much data as you can and make decisions based off your research. They say hindsight is 20/20. Well, the next one is hindsight bias. And this is where people generally remember positive outcomes from their decisions and try as hard as possible to forget any negative outcomes. For example, in 2008, how many people came out the woodwork to say, oh yeah, I knew housing was going to crash. I knew the stock market was going to crash. When in reality, if that were true, the majority of people would become rich in 2008, would have bought up homes the couple of years afterwards, and would have made the best returns possible. Hindsight bias may lead to overconfidence in your trading abilities and a general self-promotion of your investment skills that may not necessarily be there. The way to overcome hindsight bias is to ask yourself, honestly, could I really have known what would have happened in that situation or in that investment? Was there even enough information out for me to properly analyze it? Did I make a decision based off the information that was out at the time, or am I simply remembering something that didn't truly happen? Have you ever walked into a casino, won a little bit of money, and then eventually lost it later on in the night? You think to yourself, well, that's just the house's money. That's no big deal. That's called mental accounting bias. And this is where you're making investment decisions based off the source of the funds. For example, for your long-term retirement, you're going to be nice and safe about it. But your bonus money, you might put in your trading account, lose it, and go, oh well, bills are paid, I didn't really need it, that was just for the jet ski. So you structure your portfolio based off short-term and long-term goals. The way to remedy this is to actually look at your portfolio as a whole and focus on the overall return and the longevity of your money and your long-term goals. This next one is the lazy man's approach to investing, and it's called the availability bias. This is where you look for information that is readily available, easy to find, or just simply in your recollection. You might recall hearing a TV person or an advertisement online somewhere and make an investment decision simply based off that. An example of this outside of stocks is, let's say you're studying for an exam this year and you're studying using previous year exam questions rather than focusing on the scope of possible questions and information for this year. The way to remedy an availability bias is to really dig deeper and make sure that you're finding as much information as possible about your stocks so that you can make informed, intelligent decisions in your investing. One thing you will notice with what I have discussed thus far is that research, record keeping, and analyzing data can be useful in fixing cognitive errors. In other words, errors that we make with our thinking. However, emotional errors or biases are a lot harder to overcome. They are ingrained in your personality and stem from your individual experiences. They are much harder to deal with. However, just knowing that they exist can help you in making better and more informed investment decisions. So let's get started on those. When an investor considers a trade or an investment, they look at a risk-reward profile for that investment. In other words, the riskier it is, the more they're hoping to gain from it. At the end of the day, it's actually a loss that scares an investor. That's called loss aversion. This is where the pain that you feel from a loss is much greater than the joy or good feeling you get from a gain. When an investor shows loss aversion bias, they tend to hold on to their losers too long in hopes that they go back up, and tend to sell their winners too quickly because they're trying to lock in that gain. They're so fearful of a loss that they end up holding those paper losses and just waiting for the investment to go back, and it may not ever go back. You may even end up making some risky bets in order to recoup the losses that you have on investments that aren't performing well. This leads to excessive trading, lots of fees again paid to the broker, and generally lower performance for your portfolio. The best way to overcome a loss aversion bias is to ask yourself if you would purchase this investment all over again today. If the answer is yes, then you should probably consider holding it longer, because paper losses are not going to necessarily last forever. The investment may go back in the future. If the answer is no, then it might make more sense to sell it now for the loss and replace it with something that may perform better. If there's one thing that an investor or trader fears more than a loss, is a fear of regret. A regret aversion bias is where an investor is afraid that if they do something, it would end up leading to losses, and they would much rather do nothing. For example, let's say you're holding an investment that hasn't been performing too well. You worry that the second you hit that sell button, it's going to just magically pop right back up. Or the opposite. Maybe you're holding something that has done very well, and you think, as soon as I sell this, it's just going to continue to skyrocket even further, and I'm going to regret doing anything at all. So you end up taking no action in hopes that you won't regret taking some action. Groupthink or social proof bias is a form of regret aversion bias. And this is where people go with the popular consensus because they think, well, if everyone else is wrong, then it won't make me feel so bad. Rather than focusing on the short-term regret you may feel from either making or not making an investment decision, focus on the longer-term goals of your portfolio. Focus on retirement, focus on diversifying the portfolio to make sure that it's successful. Everyone has that one friend or has seen the guy or girl at the bar that thinks they're the hot. That's called overconfidence bias. When it comes to investing, this is where you believe a little bit too strongly in your abilities, even though your track record says otherwise. You're going to pat yourself on the back for any positive outcomes and blame others for any negative outcomes. Overconfidence bias can lead to excessive trading, excessive fees, and subpar investment results. To remedy an overconfidence bias, you have to be honest with yourself. You have to be strategic in your investment decisions, do your due diligence, and realize that not even the best investors can be right 100% of the time. Investing, again, is a probability and not a certainty. I can honestly say that I have been a victim of this next one, and that's self-control bias. This is where a person is focused on short-term satisfaction rather than longer-term goals. This is someone that is more likely to buy a Tesla that they cannot afford, even though they have zero in retirement and zero in their savings. They may also trade stocks that are excessively risky for their portfolio in order to satisfy the losses that they've suffered elsewhere or the lack of savings that they have. The best way to fix a self-control bias is to be smart and methodical with your investment and savings. Ask yourself if the money that you are spending today is worth what you are giving up in retirement. $10 today is worth $75 30 years from now using an average return to the market. So the next time you're spending $2,000, whether it's on a watch or a purse or a couple of new phones, ask yourself if that's worth $15,000 in the future. Everyone watching has probably been guilty of this next one at some point in their life, whether it's in their career, their relationships, or in investing, and that's status quo bias. It's inherently simple to understand. It's where you want to keep things the same and are unwilling to make changes. So when it comes to investing, this may look like keeping a particular investment or even several investments too long and not consider other potentially better investments that will be better for your overall portfolio and risk profile. It is much easier to leave your investments alone rather than ask the right questions, do the due diligence, and change your allocations from time to time. If you were treated poorly at your job or by your spouse, you would likely want to change. It should be the same for your investments. Last but not least is endowment bias. Endowment bias is where a person believes that just because they hold an investment or an asset, that it's worth more than what it actually is. I like to think of the used car market when thinking of the endowment bias. For example, if you're selling your car, you are likely to have some offers that you consider to be lowball offers. The question you should ask yourself is, what would you pay for that Lexus that you're trying to sell that has hail damage and a sticky transmission between 4th and 5th gear? Well, it's the same with stocks. Just because you own a stock doesn't mean that it's more valuable than somebody else who wants that same position. If you own a stock, ask yourself, what would be the maximum price that you would pay for that stock today? Would you even want to own that stock today? That's the best way to overcome an endowment bias, is to ask yourself, would you buy that stock with new money? Thank you for watching. If you've made it to the end of this video, please remember to smash that like button, as it will motivate me to make more content like this for you. Also, please subscribe so you can be the first to be notified of future content. See you next time.